even if you look at the stocks on Wall Street, those that did well because of the lockdown, that their time had come, whether it was a Netflix, a Zoom, a Peloton, which is, of course, into fitness tech, they're all trading where they were before the outbreak of COVID-19 or below that. Globally, there's a big sell-off that's at play for various reasons. On Wednesday, you'll have that crucial meeting of the US Fed. Will the FOMC raise rates? Will it announce 4 rate hikes this year? And that is why the markets are scared. The era of easy money, is it coming to an end? What's it going to mean for India? These are just some of the questions I spoke to Nimish Kampani of Let's Venture and Trica about. Here's that interview. In the big tech sell-off, that's the big story. We've seen charts now also how Warren Buffett has caught up with ARK Fund and Cathy Woods. We've seen that all over the weekend. Back home, what's going to be the India impact, whether we look at the recent listings, and there's a really big pipeline of upcoming IPOs too, from a Delhivery to an OYO that wants to try it, to a Pharmeasy, and the list goes on.
Hi, morning, Nayantara. Thanks for having me on the show. So I think, so let's go to the fundamentals on what is happening, right? The rally that we have seen in the past was largely driven by liquidity. Globally, I mean, right? I think the amount of liquidity that was pumped into the system was chasing new age technology stocks. The entire stock markets across the globe have been on upswing. Second, the interest rates were at a very subdued level, right? And when interest rates start rising, the companies which have a long earning equation into their business model, the PE starts getting re-rated, right? And that is what we are seeing, with liquidity being one factor, and the interest rate supposed to rise, and they expect to go to, in the US, to the risk-free rate will be around 2.5, 3. I think that is what completely re-rates the entire price to earning dynamics, and that's where you are seeing the selling pressure that you're seeing globally coming, right? And that has not left India as well, because all of the Indian companies that we have seen that have got recently listed have a very long tenure earnings to come in, right? The profitability is not yet there, and then that's why the discounting changes, and that's where the price to earning changes, and that's why the impact.
So Nimish, give us a sense of how people in India are responding. I talked, for example, what Rajiv Mishra of SoftBank has said. Shailendra Singh, the big boss of Sequoia Capital, has also publicly stated now that we need to start talking about unit economics. We need to start having a road to profitability. Basically, is the era of crazy money behind us? And then what's happening, let's say, with the HNIs and family offices? You work with so many of them. Is fear of missing out, FOMO, suddenly becoming JOMO, joy of missing out?
So that's a nice way of putting it, Nayantara. So I think if you look at it, what was, as liquidity was there, I think you'd see a lot of companies raising money. I would caveat by saying the India story remains intact, right? You will continue to see growth coming in the startup ecosystem, because we are yet at the tip of the iceberg, right? We have not even gone down the entire Bharat story yet. It has not yet played out. All the e-commerce players that you're seeing, even the listed, unlisted, have that same ballpark 100 to 150 million customers, which is largely urban centers, right? So the Bharat story has yet to play out in India. And that's why I said the startup story is a 10-year story in India. You will have these kind of blips because, of course, the listed stocks are very high beta stocks. They are momentum stocks. So when the times are right, they'll do very well. But when the tide turns out, I think they'll be largely impacted in a big way along the market, which is also impacted. But these stocks will react much sharper, right? So volatility will stay for the listed space. Coming to unlisted, I think what we had been seeing in the last 2 years play out, right? Typically a fundraise cycle for any company, right? Ideally in a normal scenario should be around 12 to 18 months, right? And it had gone to a euphoric level where you're seeing fundraisers happening every 4 months, right? Is that right? Is that wrong? No one is to say that, but I think there was a little bit of euphoria. There was a little bit, I think the FOMO was huge. Funds were writing term sheets in 48 hours. It was a seller's market, right? and with that happening, which is where now I think the tide will turn. You'll slowly start seeing the impact coming in that space, and all the leading names have already called it out. Is that you'll start seeing some sanity coming back. Right. See, in India, we have brilliant ideas. We have brilliant entrepreneurs, brilliant founders. They will continue to get the backing. Right. Good companies, good values will continue to get the backing. But in that way, you were seeing a lot of companies, maybe for example, which are pretty old. They were getting funded in their early stages. Right. So a lot of those things, I think, you will see a lot of caution coming in. You will see funds also being careful while deploying. And I think, having said that, in the good companies will continue to the good run. I wouldn't expect valuations to be impacted too much in companies which are run well, which are on a high growth trajectory, which are really solving problems. But of course, when you go down the curve, the risk pricing comes in, and then I think that is what you will see. On the family office and ultra HNI front, I think what we had seen was not too much of FOMO, right? I think there was a good amount of value picking. I think very conscious on what they are writing checks on and where they are writing checks. I think that again will continue. You will see, as I said, some amount of sanity coming into the picture. Each and every company will or may not get funded, but overall headline numbers, I think, would remain intact. And I would foresee 2020 again to be a good year for the startup ecosystem, apart from a small blip that you will see for some time now.
But Nimesh Kampani, I want to come back to the earlier question that I had asked. What happens to the upcoming IPOs? The pipeline is just so healthy, right? Forget the LIC from the government of India, which is supposed to be the Saudi Aramco moment for India. But, you've got a Delhivery, which has got its approval. A Pharmeasy's roadshows have started. You have Oyo. There's just so many of them that are coming out with IPOs.
As I had said in the past, right, tech IPOs have to be looked at it with a very different lens. You need to either see path to profitability or exponential growth, right? So one of the two things have to happen when you're looking at investing in a tech company. And what we have seen in the past, many of the companies have had large portions of offer for sale. That means the money is not going for productive use, right? And I think that is some of the things that you'll see play out. People will change their models on how they are raising money and for what they are raising money. I think valuations will normalize, right? Because I think the initial rush that you had seen was largely a FOMO-led rush where everybody want to participate in that. I think that now normalizes because with the reaction in the public markets, people will temper down their expectations, both on the amount of money they want to raise, the valuations they want to raise at. So again, that brings in a value buy for the investors who are coming in. So I think good companies will continue to raise, as I said earlier. And of course, we have seen it worldwide when IPOs come in, you have a lot of good companies, but with that, it brings a large set of companies which are not yet up there. And that's where you'll see the large impacts. And that's why you see always the statistics shows that 75% of IPOs have never done well. The reason is exactly this, right? It is quality versus quantity.
What's your message for the founders, startups, entrepreneurs? Because, it's looking like what the markets are indicating is that the era of easy money is behind us.
Yeah, I think that's a very good question. And very importantly, I think what we had seen was founders focusing too much on raising money and too much on valuation. I think it's time to go back to basics, focus on the business that we are building, focus on the values of the company, focus on building the business the right way. Yeah, I call it a sustainable, scalable business, right? I think that is what founders should focus on. You do the right things, money will come. I think valuations will come. That's just an outcome, right? Valuation is not the input for a business, but it's the outcome of the effort that has been put in. So I would recommend all founders to going back to basics. I think building the right business. India is a huge opportunity waiting for talented people to explore and exploit. And I would wish all of them good luck in that journey.